Assalamualaikum listeners, welcome back. I'm here with the second part of exercises regarding chapter number 12, accounting for partnership. In my previous recording, we did some of the examples as you can see over here, and then I left some for today's discussion. So from exercise number 12-10 to onward, we will be solving in this recording. If you have not heard the previous recording regarding the chapter discussion regarding part 1 of the exercises, I will advise you to go and listen to them first and then come back and solve this question with me. So let's start from exercise number 12-10. Prior to the distribution of cash to the partners, the accounts of VUP company are, means they have not done the distribution to the partners. It's about liquidation, because it's liquidation, you distribute the cash to the partners. Okay. So prior to the distribution of the cash to the partners, the account of VUP company are cash $24,000, vocal capital $17,000, credit. Capital has a normal balance of credit. UTEC capital credit 15,000. PINA capital debit 8,000. It means it's a capital deficiency, right? Every partner has a credit balance, but PINA has a debit balance. So he should give this money to the partnership. He doesn't have a claim. Partnership has a claim on his personal assets. Okay. The income ratio are 5:3:2. 5:3:2 means whatever, can you see 5 parts plus 3 parts altogether 8 plus 2 parts altogether 10. So whatever things, either it is profit or either it is loss, we are going to make 10 parts of it. And out of 10 parts, 5 parts will be taken by woman, 3 parts will be taken by UTEC, and 2 parts will be taken by PINA. Okay, so that's 2 by 10, 3 by 10, 5 by 10. This is how we make the ratio. Okay, VUP company decides to liquidate the company. So they are liquidating the company. Prepare the entry to record PINA's payment of $8,000 in cash to the partnership. I told you, PINA has to make them pay the money to the company. His personal assets, he has to use them, and he will be giving the money to the company. So he brought cash to the business. And then after that, when he will give this money to the business, his claim will be over, right? And then only UTEC and Google will be left. So in part 2, they say the distribution of the cash to the partners with credit balances. So whatever remaining cash will be there, we have to distribute it to other 2 partners. Okay. Part B, we will read first. Let's do part A. So part A, part 1 is PINA is bringing cash to the business. So business will get the cash and PINA's capital gets credit. He is bringing 8,000. So let me show you the T account picture. This is PINA. He was having a PINA capital. He was having a debit balance of 8,000. Now he brought the money to the business with this journal entry. So now he has no more claims in the business. This is null. Okay. So his claim is over. Debit is equal to credit. Then they say distribute the money to the partners. So for that purpose, I have to know how much money we have, right? Because this is transaction brought the cash. Let's check out. Cash. How much was opening balance for cash? It was 24,000. And now PINA brought 8,000. Can you see? He brought 8,000. Altogether, cash is going to be 38,000. Let's check capital balances. Vocal capital is 17,000. UTEC capital is 15,000. 17 plus 15 is 32,000. Distribute, right? So Vocal will get his claim back. Vocal capital will get debit. UTEC capital gets debit. 17,000, 15,000, and the cash will be distributed. And after that, nothing will be in the business. I made these T accounts which I just drew upward for you. So if you see over here, this is the cash account. This is PINA's account. This is Vogel account and this is UTech. Nothing happened to UTech, nothing happened to Vogel. Their capital balances remain same. Pina was having a debit balance, but first part wrote the credit balance for him and ultimately he has 0 and the cash was updated. Just now I made these 3 accounts for you. Let's move on towards the second part. In second part they say, it's here, part B. Prepare the entry to record the absorption of Pina's capital deficiency by the other 2 partners. It means Pina does not have personal resources to pay this 8,000 debit balance, so other 2 partners have to, absorb his capital deficiency. Now, how they will be absorbing? Same, their profit and sharing ratio. If you see here, 5 is the ratio. Let me just clear it. Okay, 5 is the ratio for Vogel, 3 is the ratio for UTech. Pina is not going to share because he doesn't have money, right? So now the ratio is 5:3. So let's build this ratio. 5 for Vogel, 3 for UTech. All together, the full sharing is 8. 5 plus 3 is 8. So 5 by 8 will be shared by Vogel. 3 by 8 will be shared by UTech. Let's do this one. This one is for all the partners. We have now only 2 partners. So for 2 partners, we are only 5 and 3, not 5 plus 3 plus 2, right? That's why my ratio is 5 by 8 and 3 by 8 right now. So let's do this. 8,000 is the loss. And bring it over here. 8,000 was the loss. Vogel is sharing 5 by 8. UTech is sharing 3 by 8. So 5,000 loss is shared by Vogel. 3,000 loss is shared by UTech. And in this way, Pina Capital gets credit because they both have given the money to the business. Or how did they give the money? Not in form of cash. They reduced their own capital claims. Okay. This is a typo error. My capital is gone from here. So it's Vogel Capital and then UTech Capital. Okay, let's prepare their updated T account so that we can make the final distribution to these 2 partners. So opening balance of cash was 24,000. In this question, nothing is brought in form of cash in the business, so that's why still we have 24,000. Vogel was having opening balance of 17,000, but because of this journal entry number 1 in part B, he absorbed 5,000 deficiency of Pina. That's why his capital gets debit. So now his credit balance is only 12,000. UTech was having 15,000. It's 15, it's not 5. 15,000. He shared the capital deficiency of 3,000. So now his claim is 12,000. This is not 5. This is 15. Please make it correct. So because UTech and this Vogel has shared the loss of Pina, so he got a credit balance. Now his claim is over, or his liabilities or his payments are over now. So now let's check, do we have enough cash? It's 24,000. How much claim Vogel has? 12,000. How much claim UTech has? 12,000. 12 plus 12 is 24. So yes, we have money for them. So Vogel capital gets debit, UTech capital gets debit, and cash gets credit. 12,000, 12,000, and 24,000. This is it for exercise number 12-10. Let's move on towards one problem exercise which I have chosen for you. Let's have a look. You know that problem exercise creates a full scenario like a case study, and then they have several requirements which you have to fulfill. So let's read this case study or this problem exercise. The post-closing trial balances of 2 proprietorships, remember, one owner company, 2 one owner companies on January 1st, 2017 are post presented below. This is Sorensen company and this is Lucas company. So they are proprietorship. One is the second proprietorship is this, and January 1st these are their balances: cash, accounts receivable, allowances, inventory, equipment, and then accumulated depreciation, notes payable, accounts payable, and then Sorensen capital, of course, in his business, and Lucas capital in his business, and then we have a total. These are debits and credits. Okay. Then Sorensen and Lucas decided to form a partnership. They were running independent businesses. Now they are going to make a partnership. Solo company. with the following agreed upon valuation of non-cash assets. Can you check? We have accounts receivable, we have inventory, we have equipment. These are non-cash assets. And also we have allowances which are associated with accounts receivable. They are contra asset. So for these non-cash assets and their contra, they get these agreed upon values. Agreed upon values means market valuation they get. Okay. And we know that we don't consider the book value, we consider fair value or market value, no more book value, right? So let's check out. Sorensen has accounts receivable of 17,500. They were 17,500. Allowances are 4,500, but they were 3,000. So we will not take 3,000, we will take 4,500. For Lucas, 26,000 were accounts receivable. Yes, they have 26,000 accounts receivable. Allowances were 4,000. Can you see? It's 4,400. We will not take this. We will take 4,000. Inventory for Sorensen is 28,000. Where is inventory? They have 26,500, but we will not take this. We will take 28,000. And inventory for Lucas is 20,000. Where is Lucas? Lucas is over here. We will not take 18,400. We will take what valuation we get. That's 20,000. Equipment 25,000. What is equipment here? 45,000 was the cost, and the accumulated depreciation was 24,000. So basically 21,000 was the book value, right? Cost minus accumulated depreciation. We will not take this. We will take 25,000 valued amount. Okay, equipment for Lucas is 15,000. Let's check out. Equipment for Lucas was 29,000 cost, 11,000 was accumulated depreciation, so 18,000 was the book value. But what we get as market value, 15,000. So we will take this. We will not take 18,000. Okay, let's read further. All cash will be transferred to the partnership. So whatever cash amounts are there, they are exactly going to the partnership. And the partnership will assume all the liabilities of the two proprietorship. All these liabilities will be accepted by the partnership. So notes payable in the partnership will be 18,000. Let me just clear this area so that I can discuss. Okay. So notes payable is the first liability, then I have accounts payable. So notes payable will in partnership will be 18,000 plus 15,000, both owners together, okay? And also accounts payable, I'll be adding both of them because they said all the liabilities are accepted. Further, it is agreed that Sorensen will invest additional 5,000 cash. So Sorensen is bringing additional cash, and Lucas will invest an additional 19,000 in cash. So more cash is coming. This cash is already there. We'll just add it, but we have to pass the journal entry for this additional investment, and it will also increase the cash. Okay. What we are supposed to do? We are supposed to prepare the separate journal entries to record the transfer of each proprietorship assets and liabilities to the partnership, and then journalize the additional cash investment by each partner. And also they want us to prepare the classified balance sheet on the same date when the partnership started its business. Okay, so let's start from first requirement, which says journalize the transaction. So I'll be firstly recording for first partner, which is Sorensen, and then I'll be recording for Lucas. Let's check it out, what things we can record for Sorensen. Okay. Sorensen is bringing cash to the business, 14,000. So cash will get stabbed. He's bringing accounts receivable of 17,000, take the market value, and 500. And allowance will get credit with 4,500. He's also bringing inventory of 28,000. He's also bringing equipment of 25,000. He's bringing notes payable of 18,000 and accounts payable of 22,000. And then by netting off assets and liabilities, we can calculate his capital. Okay, so let's do this. I'm recording the first journal entry. January 1st, he's bringing cash, accounts receivable, inventory, equipment, and he also brings allowances for doubtful account. He brought notes payable of this amount and accounts payable of this amount. When I add all these assets and I deduct these liabilities, so I get a capital balance of Sorensen of 40,000. Same I'm going to repeat for Lucas. If you see here, Lucas brought these assets. He brought cash cash of how much? 12,000. He brought accounts receivable of 26,000, allowances credit 4,000, inventory debit 20,000, and equipment debit 15,000. He also brought notes payable of 15,000, and he brought accounts payable of 31,000. Do remember, all the assets have normal balance of debit and liabilities have normal balance of credit. Okay, so by this time you all should be expert in knowing this. So let's check it out for the journal entry for Lucas. So he get cash, accounts receivable, inventory and equipment, and allowances for doubtful account was 4,000, notes payable and accounts payable. So when I add all the assets and deduct these liabilities, his capital is 23,000. Part B says that record their additional investments on January 1st. Sorensen brought cash of 5,000. So cash gets debit 5,000 and his capital gets credit 5,000. Lucas brought 19,000 cash and his capital gets credit 19,000. Third requirement says that prepare the classified balance sheet with all these assets and liabilities and the capital balances. So let's prepare this. This is solo company classified. Remember, in classified balance sheet we have segregated, means we mention assets, the current assets, the non-current assets, all of them separately. Okay. So solo company, which is partnership balance sheet, January 1st 2017, because on this date we are preparing. Firstly, we'll be mentioning assets, and under assets we'll be mentioning current assets first. Let's record cash, first current asset. Check the journal entries. First journal entry has given the cash of 14,000. Second entry gave the cash of 12,000. Third brought 5,000 and 19,000. Add all these four values, right? So can you see here? I did this over here. I added, and 50,000 is the cash for the business. Accounts receivable. This is first journal entry, accounts receivable of Sorensen, and this is the second journal entry, accounts receivable of Lucas. So when I added only accounts receivable, not the allowances, okay? When I added them, they are 43,500 less allowances for doubtful account. Allowances for Sorensen was 4,500 in the first journal entry, and second journal entry Lucas allowances were 4,000. So together total allowances are 8,500. They are contra, right? So they decrease our accounts receivable. So my net realizable value of accounts receivable is 35,000. Then inventory, Sorensen's inventory in first journal entry is 28,000 and Lucas is 20,000 in the second journal entry. When I add them, they are 48,000. So altogether the total current assets are 133,000. Then we have property, plant and equipment, and in that we have only equipment. No need to mention accumulated depreciation because we are not talking about book value, we are talking about market values. So the market value for Sorensen equipment was 25,000 and Lucas equipment was 15,000, so total is 40,000. So when I add these current assets with the non-current assets, total assets are 173,000. Moving on towards the owner's equity section, the first journal entry has given the notes payable of 18,000 and the second journal entry gave us notes payable of 15,000. So I added them and they are 33,000. Accounts payable are 22,000 plus 31,000, so 53,000. So total current liabilities are 86,000. Then owner's equity comes. Sorensen first journal entry gives a capital of 40,000. And his third journal entry has increased his capital with 5,000 where he invested the cash. So its updated capital is 45,000. Lucas' second journal entry capital was 23,000 and the fourth journal entry where he brought the cash of 19,000. So his total capital becomes 42,000. When I add these two, I get 87,000 of owner's equity. So current liabilities, we don't have non-current liabilities, and 87,000 when I add them, they are 173,000. Can you see? Asset side is equal to liabilities and owner's equity side. If your both balance sheet sides are not balanced, it means that you did some mistake in the journalization of the transactions. So this is it about the discussion of chapter number 12. Exercises. I hope they are clear to you. If something is confusing you, please write in the comment section so that I can solve your issues and I can discuss them. Again, please subscribe to the channel so that you can get the notification of upcoming videos. Please practice these questions as much as you can, and I hope these concepts will be clear to you. Take care everyone. Bye.